Banks are in trouble again, so perhaps it's time to have a look at the general stock market. And welcome to myfinanceteacher.org. So last time we looked at the general stock market. It was in mid-March, just around this daily cycle low. And as I mentioned back then, the video is still on YouTube, of course, from the 14th of March. I was expecting a bit of a bounce, and that's exactly what happened. Although, to be honest, I wasn't expecting the bounce to be that strong, as by the time of the video, that intermediate cycle that we were in was about 5 months long. Hence, I was expecting a bit of a bounce into a third daily cycle, followed by a decline down into the intermediate cycle low, maybe a little bit past the usual duration of 6 months. And what transpired is that, yes, we did have a bounce, and this bounce has been pretty strong. We kind of retest those highs from earlier this year. And if we are still in the same intermediate cycle that started all the way back in October last year, we would already be at about 6.5 months long into this cycle. So based on the strength of this bounce and the slightly longer than expected duration of this intermediate cycle, I see a couple of scenarios for S&P 500. The first scenario, perhaps a little bit less likely than a 50% chance, say 35 to 40% chance, is that we are still in that intermediate cycle that started all the way back in mid-October last year, and we're now 195 days into this ongoing intermediate cycle, with perhaps another 1 or 2 weeks before we might actually see the intermediate cycle low, giving us an unusually long cycle lasting for over 200 days. It's possible, it has happened in the past multiple times, but it's not extremely likely. So what would happen in this case is perhaps a bit of a short-term bounce after continued decline with the troubles in banking, as those troubles imply that the Fed might be less hawkish, might even be dovish on the 3rd of May. If that actually doesn't transpire, the general stock market might drop down into the intermediate cycle low over the next couple of weeks, followed by a gradual recovery into a new intermediate cycle. Perhaps with a bit of an intermediate cycle low aligning with the uptrend we've seen since Christmas last year. Perhaps a bit of an alignment of these lows might provide some support in this scenario. That would give us an intermediate cycle lasting for perhaps around 7 months. Another scenario for S&P 500, and perhaps that scenario has around 60% chance, perhaps slightly more than 60% chance, is that we have seen the intermediate cycle low in mid-March. So we can have our zigzag over here denoting that the intermediate cycle low is behind us, and the previous intermediate cycle was again slightly shorter than usual at only 5 months long, with the usual being around half a year. In that case, what we are observing right now is perhaps a bit of a decline into the first daily cycle low, into the end of the first daily cycle of a new intermediate cycle. So if we zoom in a little bit and perhaps try the Fibonacci retracement numbers, again, as I mentioned many times in my previous videos, 38%, 50% and 62% retracement are the most common ones. And in this case, the 38% aligns with the 50-day moving average, so there might be some support over there. And the 62% retracement is not extremely far from the 200-day moving average. So this second scenario would expect a continued decline down into the daily cycle low of this new intermediate cycle, perhaps coming close to that 200-day moving average into that FOMC meeting on the 3rd of May. And even if the Fed hikes by another 0.25%, if the following discussion is relatively dovish, that might actually provide another boost to the stock market to push into the second daily cycle of this relatively new intermediate cycle. And as usual, these daily cycles last for around a couple of months, so we would have perhaps at least a month or so of a nice comfortable rally into the top of that second daily cycle. Whether the first or the second scenario plays out, a lot actually depends on the FOMC meeting on the 3rd of May. And just as I mentioned at the beginning of the video, the banks aren't doing that well over the last few days. These are the Spider Financials XLF. You see they dropped by around 4% over the last week. These are the Nasdaq banks, KBW, which dropped by around 8% since last week, and they are pretty close to breaking below the recent lows. That might actually be quite painful. That might actually bring follow through to the downside. And if that happens early next week, right before the FOMC meeting, that might actually imply a relatively dovish outcome of that meeting. By the way, the Fed decision also has pretty interesting implication to the price of gold, and I'm probably going to release a video on that over the next couple of days, so stay tuned. So let's have a look at this Fed Watch tool. At the moment, the market expects that the Fed is going to raise rates by a quarter point with a probability of around 74%. But if you compare to last week, this probability of higher rates dropped from around 85% down to 74% today. And let's see what happens over the weekend. Perhaps this probability might actually drop further down if banks don't recover over the next few days. Banking troubles continue over the weekend, bringing the stock market down to that 200-day moving average. That might spook the Fed a little bit, again raising the probability of that second scenario from around 60 to 65% chance right now to something noticeably higher. And next, let's have a look at the market sentiment, which is very important when looking at these intermediate cycle lows. And back in mid-March, while I was expecting a short-term bounce into the third daily cycle followed by another drop down into the intermediate cycle, now that we look at it again with a relatively strong rally behind us, we see that, well, even back in mid-March, this decline in the optimism index, the market sentiment, has actually been severe enough to pretty close to this green line, which does usually happen with those intermediate cycle lows. So again, while the markets can drop out of bed here, bringing us another sentiment decline all the way down to that green line, we had already been close to the green line in mid-March, which might have been enough for that intermediate cycle low, hence giving around 60% chance to that second scenario of only a short-term temporary decline over the next 1 or 2 weeks, followed by a continued rally, at least in the intermediate term. But looking back at this chart for a very long term though, it's still questionable whether we are going to see a recession later this year or next, as many are discussing right now. So if you're a longer term investor, I think it's not a terribly bad idea to have some cash that you might deploy if the stock markets do give you that significant discount. You would be pretty happy about that. By the way, in being happy, I would be pretty glad if you hit that like button and share this video with your friends. If you like this analysis, there is much more at myfinancesteacher.org. with a membership fee at only $10 a month, which is basically nothing in the current inflationary environment. In addition to regular updates on a range of assets, perhaps one of the highlights among the publications is this monthly uranium report. I posted the recent one just a few days ago, so feel free to join us to have a look at that and much more. Have a nice day. Bye bye.